Good morning, Principal Sir, teachers of Sri Krishna Vidya Mandir Ramgarh. I take these opportunities to present myself as a resource person for today's training session on Basic in Accountancy. I welcome all the participants. So let's start the session. Welcome all the participants for today's training session on Basic in Accountancy. First, we want to know what is accountancy, and today's agenda is what is accounting, mode of learning accounting, accounting and finance, differences, accounting concepts and conventions, accounting events, rules of accounting, preparation of financial statement, and a simple case study. Let us start. What is accounting? Accounting is the art of recording, classifying, and summarizing the financial events in chronological order in books of accounts. So, accounting is also defined as the art of recording, classifying, and summarizing transaction in monetary terms in money terms for the preparation of financial statements. What is accounting? Accounting, it is the art of recording, classifying, and summarizing financial terms and transaction in the preparation of financial statement. Recording refers to creating journal entry for every transactions with debit and credit amounts. So classifying refers to classifying each of the debit or credit transaction to capital of revenue and assets, liabilities, revenue or expenses. Summarizing refers to grouping the transaction of assets, liabilities, revenue and expenses and preparing the financial statement such as trading, profit and loss account and balance sheet. In case of trading, manufacturing and customer services oriented organization, the sum of all income expenses is related to as profit and loss account. Social service oriented organization like school, hospital and government organization, bank, it is referred to as income and expenditure account. Note mode of second mode of learning accounting changes your mind that accounting means only debit and credit. Do not blindly learn accounting rules and apply the rules of debit and credits. The best way to learn accounting is learn the accounting concepts, understanding the accounting conventions, classifying the accounting event, apply the accounting rules, record, classifying and summarize the journal. A mode of learning accounting. First, learn accounting concept. Fundamental of accounting concept. Understand accounting conventions. Three major conventions classify the accounting events: capital, revenue, deferred revenue, expenditure. Apply the accounting rules: personal account, real account, and nominal account. Record the transaction as journal, entering the debit and credit side of transaction. Classify the transaction: assets, liabilities, revenue, or expenses. Summarize the transaction, prepare trial balance, trading, profit and loss, and balance sheet. Going to the next slide. Finance and accounting differences. Finance. Let us start difference between finance and accounting. Finance. What is finance? Finance means procurement and utilization of funds, while accounts means recording of and accounting events. While next difference is leads to investment decision, while accounts is expressed in monetary terms. And in finance, financing decision is taken, and in accounting, recording transactions, classifying and summarizing the transactions. Next difference is futuristic. Finance is futuristic in nature, while accounts is prepare of financial statement like trading account, profit and loss account, and balance sheet. Next difference is finance is cost of capital, while accounts is historical in nature. Next difference is finance is used for cash flow, fund flow, while account is used for compliance with the statutory matters like Companies Act, Income Tax Act, Sales Tax Act, and etc. Next slide is what is accounting concept or convention. Why like GAAP, UK or GAPS. The concepts and conventions of accounting are developed by International Accounting Standard Committee, which is in charge of releasing international accounting standards. The IAS, yani Accounting International Accounting Standard Committee, decide the preferred accounting practices worldwide and encourages the worldwide acceptance. These are 41 international accounting standards. So now International Finance Reporting Standards and Sarbanes-Oxley Act gain more importance, which came up from US GAAP and UK GAPS. Next slide is differences between concept and conventions. The accounting concept or principle evolves out the practice and procedure followed by different countries and later on established by the international statutory accounting bodies like the Institute of Chartered Accountants of India, the Institute of Chartered Accountants of England and Wales, etc. To become an accounting principle, statutory needs to be followed while preparing the financial statement. In not sale, this has evolved out of standard practice followed by several countries while preparing the trading account, profit and loss account, and balance sheet. The accounting conventions or practices are basically assumptions and expected to be followed while preparing the financial statement. Next slide is accounting concept or principles. First concept is basic entity concept. Explain करें? Basic concept, basic entity concept means each and every organization is a individual body. Next concept is money measurement concept. Business transaction is recorded in books of account, that transaction which are in monetary item. Next concept is dual aspect concept. It means कि all transactions are recorded both sides, two sides. Next concept is cost concept, and next concept is accounting period, and concept is conversion, realization concept, matching concept, materiality concept, and objectivity. Next slide is accounting convention or practices. First concept is going concern, consistency concern, and accrual basis. Accounting concept, business entity concept. Accounts can be kept only the entities which are different from the persons who are associated with this entity. Example, sole proprietary, partnership, firm, company. Accounts need to be maintained separate from the owner and the provider of capital. If you understand the simple logic, then you know 30% of accounting. Just result fundamental of accounting from perspective level. Example of bank, any company, etc. Now next is types of entity. Types of organization is sole proprietorship, partnership firm, private company, public company, trust, society, etc. Accounting concept like business entity concept, it is you are running your business. If you are running a business, running a business owned textile showroom as a dealer in cloth, as the accounting concept, money measurement concept. Records should be made only of that information which can be expressed in terms of money, that is currency value. For example, sole proprietor had 40 tables and chairs. This cannot be recorded unless a value of furniture is known in monetary value. For example, very famous Indian example is Rama killed Ravana. Can this be accounted? No. Why? Because it is not expressed in monetary terms. My wife loves me so much. Can this be accounted? No. Why? Because it cannot be measured in monetary terms. So we can say that we can only record those transactions which can be measured in money. Next concept is money measurement concept. A normal doubt comes to your mind in the first and fourth example in previous slide, how to get the value. We should not be taking the purchase value, but we should take the market value on the date of transacting the asset to business. This is an exception to cost concept only in case of transaction to another business. Next slide is accounting concept, dual concept. The value of assets owned by the concern is equal to the claim on the asset. Claim means liabilities. Asset equal to liabilities plus owner's equity. It is always true that all total of all asset is equal to liabilities plus owner's equity. Owner's equity means assets minus liabilities. So we can, if we want to find out owner's equity, we do that assets minus liability. We can find out our owner's equity by differentiation between assets and liabilities. If we want to find out liabilities, then we can do assets minus owner's equity. Next concept is cost concept. Assets are always shown at their cost, not at their present market value. It is the rule that always we show the value of assets in the balance sheet on cost, not on the market value. For example, a land purchased for rupees 5 lakh will be recorded only rupees 5 lakh. Even through market value may be lower, say rupees 4 lakhs, or higher rupees 6 lakh, then the cost price will be shown in the balance sheet only. We cannot change the value of assets because it is the rule of recording of transaction that all assets will be recorded at their cost price. Next concept is accounting period. Accounting measures activity for a specified interval of time, usually 1 year. It means Calendar year is January to December, while financial year is started from 1st April and ended with March 31st. Choosing the accounting period, the entity choice, but there are legal rules like Companies Act and Income Tax Act which prescribe the period in which the entity has for report to them. So remember, still entities can have different accounting period for their own internal management reporting. According to their own reporting, they can choose any one, but company cannot change their financial year. A company in India can have for company law purpose January to December year and income tax purpose April to March. And for a own internal reporting July to June. So we can say the entity cannot change their accounting period without getting proper approval only in case of company act and not possible without with income tax authorities. Next concept is conservatism. Anticipated profit but provide for all possible losses. Profits are not recorded. Anticipated profit we cannot record, but anticipated loss will be recorded. Accounting are by nature conservatism and also to period the interest of the shareholders and creditors required to provide for all losses. For example, if we are a government company and there is a possibility that government will withdraw the subsidy for fertilizers in the forthcoming budget, so we cannot be provide loss of subsidy as a loss now itself. Next accounting concept is realization concept. The sales is considered to have taken place only when either the cash is received or some third party becomes legally liable to pay the amount. Revenue are recognized when they are earned or realized. Realization is assumption to occur when the seller receives cash or a claim to cash in exchange for goods or services. For example, a sales invoice for rupees 1 million, credit notes for rupees 15,000 received. So it is example. For instance, if company is awarded a contract to build an office building, the revenue from that project would not be recorded in one lump sum, but rather it would be divided over time according to the work that is actually being do or done. Our next concept is objectivity concept. and even evidence of the happening of the transaction should support every transaction in the fourth for papers. External evidence is considered to be more authenticated proof that internal evidence. This rule is more important from audit present perspective, as auditors always consider and bound to get more external evidence than internal evidence. For example, third party evidence, credit note from supplier. Next accounting concept is going concern. Accounting records events transaction on the assumption that the entity will continue to operate for an indefinitely long period of time. An entity will not be started with an intention to close within the specified time periods. So business is always not started with an intention to close, and it is expected to continue forever. Next accounting concept is consistency. The accounting policies and method followed by companies should be the same every year. For example, periods should not be changed frequently from January to December or to April to March. Or inventory valuation change from FIFO and LIFO or weighted average not permitted frequently. It means the rules always used same. Changing depreciation policy from straight line to reducing balance method frequently is also not good for any organization. Next accounting concept is accrual. In general, it is assumed that accounts are always prepared based on accrual basis. However, there are entities which follow cash basis of accounting also. For example, salary payable to employee, March salary paid in April, interest receivable on investment, dividend receivable on shares, tax payable to government. The Company Law or Income Tax Act prescribe all companies to follow accrual basis of accounting except for professional film and government organization, which are allowed to follow cash basis of accounting. Our next slide is classification of accounting event. All transactions are classified according to their nature. First is revenue item. What is revenue item? An income or expenditure, the benefit of which will be adjusted within a year, that is the calendar year or a financial year, whichever is set up for the set of book. It means the financial year should be decided before starting the recording of transaction. For example, salary and wages, printing and stationery, sales revenue, interest, income, salary payable, bonus payable, tax payable, etc. In simple term, we can say that this is an event which generates revenue, and the related cost to earn the revenue are accounted as expenses. how we can classify the accounting event? So we can classify that what is deferred revenue expenditure. It is neither a capital nor revenue, and the benefit of which will be realized for more than 1 year, exceeding beyond the calendar for the set of books, and does not result in creation of an asset. For example, advertisement expenditure, the benefit of which is likely to be obtained over a period more than 1 year. And another example is royalty paid to the author of the book for 5 years. It is the example of deferred revenue expenditure, which benefit we will get for a long period of time. Up now going to explain our golden rule of accounting. There are two rules: personal and impersonal. Personal, what is the meaning of rule of the personal account? The rule of personal account is debit the receiver and credit the giver, because person always receive or giver of anything, so we record the personal account according to the rule of debit and credit, that is debit the receiver and credit the giver. For example, sole proprietor and company are the example of personal account. Next rule is real account and nominal account. The rule of real account is debit what comes in and credit what goes out. For example, cash, bank, building, furniture, investment, etc. They are coming or going out of business, so we can record this transaction as according to the rule of real account. Debit what comes in and the item which are going out from the business are recorded as credit. And next golden rule is nominal account. What is the rule of nominal account? It is the rule that debit all expenses and losses and credit all income and gain. In business concern, there are different types of expenses and revenue. We can record them according to nominal rule. If we expense, we record it in debit side, and if we get income, so we record them in credit side. For example, sales, rent, electricity bill payable, etc. Next slide is application of accounting rule. First we check whether there is a money transaction involved or not. Then, is that transaction affect your set of books? Next, check the whether does the transactions falls under which accounting periods, and does the transaction involve personal account, is that person is receiver or giver in the transaction. Accordingly, debit or credit the person account. If person is receiver, then we record it in debit side. If person is giver of anything, we record them in credit side. Does the transaction involves any cash inflow or outflow of cash? That means it is recorded as the rule of real account. If it comes in business, we record it in debit side, and it goes out from business, we can record them in credit side. If there is no cash involvement, then the choices are followed. Both can be debit or credit, both real account. One real and one nominal account. Debit or credit for real or credit, do not for nominal accounts. Accounting rules of thumb. Name of the account is assets. Asset is always debited, so it increase. If we debit the asset, it value of the asset will be increased. If we record asset in credit side, it the value of asset will be decreased. Like that, liability is credit in nature, so if liabilities is credited, the amount of liability will be increased. If liabilities are debited, the amount of liability will be decreased. Like revenue, if the revenue is nature of debit or credit, if revenue is credited, the amount is increased. If revenue is debited, the amount is decreased. Expenses is in debit in nature, so the value if we record the expenses in debit side, the amount of expenses will be increased. If we credit the amount of expenses, the amount of expenses will be decreased. Profit is credit in nature, so if we credit the amount of profit, the amount of profit will be increased. And if we debit the amount of profit, the amount of profit will be decreased. Like that. Next rule is combination of rule. Uh, all of you can see the chart. What is the rule of debit and credit? According to rule of debit and credit, personal account will be debited, real account will be credited. This is called combination of rule. Next slide is for recording of accounting transaction. Recording of an accounting event is known as journal entry. Recording is made in primary and secondary books in manual accounting system. Our primary books are general ledger, cash book, and secondary books are purchases register, sales register, fixed assets registers, return, purchase return or sales return maybe, and journal register. Next process, how we prepare the financial statement. Preparation of trial balance. First we prepare trial balance on the basis of debit balance and credit balance of ledger. If sum of debit and credit balances is equal to 0, it means our all mathematical calculation is and accounting record is true. Now, how we prepare trading and profit and loss account and income expenditure and balance sheet. Trial balance is the base for preparing financial statement. Adjustment entries are made in adjustment period and passed as journal voucher before making the financial statement. Trading and profit and loss accounts always for a period, say for an year, January to December or April to March. Quarterly for 3 months or half year for 6 months may be prepared. Balance sheet is always as on date as on 31st December 2007 or 31st March 2008. Accounting concept as a simple case study. Case study is like Siva started business in dealer in computer spare parts and computer stationery on 1st April 2007 and following events occurred in the month of April. First transaction or event is Siva invested, used 50,000 cash and used 50,000 worth of furniture. And Siva purchased used 75,000 worth of goods on credit. Siva friends Ajay promised him to give a loan of US dollar 25,000. Siva sold US dollar 50,000 worth of goods for US dollar 1 lakh. And Siva paid rent in US dollar 2000 for 2 months. Siva paid salary to staff in US dollar 5,000. Siva incurred in US dollar 5,000 on interior decoration which will last for 2 years. Siva sold in US dollar 10,000 worth of goods on credit for US dollar 18,000. Siva has a bank account with Citibank which credited in US dollar 5,000 wrongly of John account. Purchased vehicle for in US dollar 25,000 paid through bank. Cash deposited by Siva into bank in US dollar it is 50,000. These are the example of case studies. Are you ready for the game? Accounting is very simple. Accounting terminology. Before creating accounting transaction, let us recall and learn few accounting terminologies. Assets. Any property or investment which can be convertible into cash is called assets. And liability is amount payable to provider of goods and services, for example creditor and capital provider are the example of liabilities. What is the meaning of revenue? Amount earned out of the sale proceeds and the amount earned on investments. And expenses is amount incurred or expended to earn the revenue. These are the example of accounting terminology. Accounting calculation formula is there are two parts in accounting calculation of formula. One is for debtors and second is for creditors. Accounting entries for the case study are first is cash account debited to furniture account. Cash is real account and it will be debited and recorded in debit side. And furniture is also assets and it is a real in nature, so it is also recorded in debit side. And both the amount which are used for investment in business is called capital, and capital is a personal account and it is recorded in credit side. So it is recorded in credit side to Siva's capital including cash and furniture. These are the some entries of case studies. You can see on the screen. This is the format of trial balance. After journal entries and ledger, we prepare trial balance. These are the item of transactions and ledger accounts are recorded here. Next is profit and loss account for April 2007. This is the format of balance sheet. Through balance sheet we find out the financial position of business enterprises. Now important points to be remembered. Accounting can be learned only by practice and not by reading. So we can practice regularly. Try to learn by creating journal entries with example also. Cash balance can never have a negative balance at any point of time because we cannot pay more than cash we have. Land will never depreciate and it will have only appreciation. The value of land never decreased. Bank can have negative balance if you have overdraft facility because bank provided businessman overdraft facility in zero balance. So we find that sometime bank balance will be negative. The bank which maintain your account will have exactly opposite entries of what is shown in our bank account. In the above example, the bank accounting accounts in your books and in bank books will be as follow. This is the important points. There is a question given for practice. This you can see it on screen and try to solve it. How to approach to learn? I this is only I tried my best to teach accounting in simple way. This is only in beginning. You have to practice a lot to learn. The simple way to learn accounting is as follows. Do not go for advanced level books without understanding the basics. Always start with accounting books in case of people in India and pre-university books in case of other countries. Try to understand and apply the concept and rules. There are areas like depreciation, provision, amortization, etc. might not have covered in this presentation. I I do not want you to go into advanced level without understanding the basics. Never try to memorize the concepts and rules. This is more than sufficient for any non-accounting candidates to work on any accounting application. Read and practice level 1 and 2 at least 3 times. Swami Vivekananda has said a beautiful quote. There is a difference between an objective and action. Unless you understand your objective, you will be wasting your time in action. Thanks all from my sides. That's all. If my participant has any doubts, if any participant has any doubts, please feel free to ask. I will try to clear all your doubts. With these words, I would like to conclude today's training session on basic in accountancy. I would like to thank Honorable Principal Sir and COE Patna for giving me this opportunity. I would also like to thank all the participants for joining us. That's all from my sides. Attendance come assessment link will be given in chat box. Please fill it before exiting the exiting the session. Thank you.